Hello, this is Edward with nonaccountant.com, and today we're going to learn why accounting rocks. And accounting is a very important subject. And unfortunately, I've seen a lot of businesses just struggle just because they didn't understand that picture or that story. And that's all accounting is. And it's just a story of your business through financial statements. And just seeing individuals that have good businesses, good services, a loyal customer base, and they struggle because their lack of understanding how the world of numbers and how the world of money works in the business environment. And I want to, share with you today because this thing can be conquered. It can be learned, and it's not hard. A lot of people say, well, that's confusing. Well, think about all the challenging things that you've learned, just through being familiar with something, just through, taking the time to learn it. And I've seen individuals lose their business just because they did not. And I'm for real. You can really lose your business just because of not understanding that money picture, that financial picture, what's going on. Just kind of lose control over a business. And because it's basically accounting is going to paint that picture for you. And as a business owner, it's your job to make those necessary strategic moves to keep everything afloat. So, guys, I want to share with you today something that means a lot to me, accounting. As you know, it's one of my passions, just helping people understand accounting, helping businesses use this information to grow, to stabilize, to build better businesses so they can impact more, serve more. So this is our accounting equation. Now, this will appear to be Greek to you, but we're going to break it down today. This is the accounting equation. You'll see assets equals liabilities plus equity. And let's see. Yes, we need some color. So that looks much, much better. So when we look at this equation, assets equals liabilities plus equity, this is very powerful. It's going to, and it is just a modified balance sheet. That's all it is. It's just a balance sheet. So what we did, we're going to do some algebra, and basically we're just going to move the liabilities across the equal sign, just like how we did in algebra back in school. And that's the same as assets minus liabilities equals equity. Now this may look more familiar to you because it looks like a traditional balance sheet. You take your assets, you minus your liabilities, you get your equity. So what we're going to do, we're going to look at it this way because it's going to show us something very key to business, and we're going to use this example. So we're gonna draw a line between our equals. So we have our assets on our left. We're going to look at our liabilities and equity on the right. Now let's use this example to help you understand accounting. Let's say that we buy a house, we invest in a home. So this is an investment for $100. So we go to the bank, we get a loan for $90, and then we're going to put down our own money. So we're going to make a down payment. You'll make a down payment of $10. Now look at this equation. So the assets are worth, your investment is worth $100. Now you have $90 worth of debt, which is the liability. And now you have $10 worth of equity, the personal money you've put into your company. Now look at this, it balances. So 90 plus 10 will give you 100. It gives you the value of the asset, the value of the investment on the left, the house, the home for $100. So this is very key because it's showing us the double entry system, how it works. And this is like a big hang up to a lot of individuals in business, not understanding that double entry system. And in accounting, whenever a transaction occurs, at least two accounts are affected simultaneously. So you'll see in this example, we've had 3 accounts affected simultaneously. And it's basically showing us what we have that the investment, the asset, and then how we obtained it. So what we have on the left side, and then on the right side, how we got it. And that's very key, because you need to know how you got something. And we're gonna elaborate that further as we go into the examples. So we just look at this. Again, this is the same as assets minus liabilities equals equity. It's just a balance sheet. And if we look at it this way, our $100 investment minus the $90 in debt, that's going to give us a net worth or equity of $10. So it's the same thing. It's just on our other example, we were able to section off how we financed it. Okay, so let's look at this. This is, again, what you have, the investment, and how you got it. So you either got it from debt, other people's money, or you got it from equity, money that you generated. And that's very key. So the mission is cash flow. That's the mission of business, even in your personal life, creating cash flow. Cash flow is the generation of cash. And cash is considered an asset. So it's going to be listed as one of your assets on your balance sheet. And assets are used to generate the most liquid asset, which is cash. And when we say liquid in accounting, liquidity is basically just, if something is liquid, it's closer to cash. And cash is the most liquid asset because it is already cash. Like land would not be, it would be called a fixed asset or a long-term asset, because it can't be liquidated as quickly into cash. Usually it takes a while for you to sell land, and going through those transactions, and then generating cash from land. So usually it's considered a long-term asset. So it's going to be listed last. And you list your assets in order of liquidity. The most liquid will be the first, the least liquid, or the ones that will take longer to convert to cash or sell, those will be listed last on your balance sheet. So we have, again, assets equals liabilities plus equity. We're going to put a little more detail in this. So assets are simply investments, your liabilities and equity. So we have type of assets: inventory, equipment, land, buildings. So these are things you're going to use. In cash, we have that bold because cash is an asset, but you're going to use these assets, inventory, equipment, land, building, etc., to help you generate cash. So your liabilities and equity, that's your mode of financing, or it's how you finance that investment, or how did you obtain that investment or asset. So you can get it through, you can, use debts, other people's money to receive an asset or get an investment. And through the equity side, we're going to break it down. Equity is two things that make up equity in business. Owner's equity, which is your personal contributions or profits. And this is basically just the contributions from operating your business. So profits flow from your P&L. That stands for profit and loss statement, also called an income statement. So if you want the detail behind that profit, that would be revenue minus expenses. That's how you get that number. So in this example, if your profit was, would you say $100? So if your revenue was 500, then that means that your expenses were 400. That's how you got your 100. So your P&L, or your income statement, profit and loss statement, is going to give you the detail behind how you generate that profit. How much was your revenue? How much was your expenses to get down to your profit? So the big picture I want you to understand is that our goal is to generate cash. And so we use investments. We're going to secure other investments to help us in this process. So to get those investments, we're either going to have to get debt, use other people's money. We're going to have to either contribute our own money, like bootstrapping, starting up, or we can use the profits from operating our business to help us finance those assets. And those assets are going to help us run our business, but run in a way that it helps us generate cash flow. So financial statements are very important because they show us how we generate cash. It shows us other activities as well, but we get to see, okay, how are we generating cash? Because that's when you think about it, that's the game of business. You want to create a cash cow, or you want to create something that's going to generate cash flow. So our financial statements, our balance sheet, cash flow statement, income statement, they all show us how cash is affected through our actions as a business owner. And guys, you can use this as personal as well. So I had a mini class, are you personally profitable? So you want to basically structure or look at your finances as if you are a business, because the idea of a business is to be profitable, right? So you want to be profitable as well through your personal endeavors. So we can increase cash 3 different ways. And again, we can do it through debt, other people's money, equity, your personal money, or revenue from your business or from your operations. So think about this. What do you think will be the most stable way to create a business long term? You guessed it. It's going to be through profits, which come from generating revenue and then controlling your expenses. That's how you get your profit. So profit is basically, again, income, sales, revenue, same word, minus expenses to give you. That's how you're going to come down to your profit. So why is revenue? Because that's what you go in business for. Other people's money, or your own personal money. If you have too much cash generated from those areas, it's okay probably in the beginning stages, or if you're trying to grow, you need a cash infusion to grow. But if it's sustained, that just shows that you don't have a strong revenue model. And that is what makes a business, generating revenue. And even that's how you improve your personal finances as well, having money coming in, through work or through your salary, just having enough money coming in and controlling those expenses so that you have profits or money left over. So, and think about the color of revenue is green. That stands for stability, growth, regeneration, rebirth. So that's the most stable way of creating a business, having a strong revenue system. So it comes down to this at the end of the day. Good bookkeeping will give you business growth, because if you have the accurate information and you act upon it, that's going to allow you to scale. That's going to allow you to grow. That's going to allow you to organize. And good bookkeeping allows you to helps you see what systems need work in my business, or how can I optimize, how can I streamline, or if I'm losing money here, how can I prevent that? Is it the AR policy I have? Is it my AP process, or is it just the way that you are running your business? And it can, just through having good bookkeeping, which will flow over to having good financial statements, being able to look at these things, they're going to show you and tell you like what you need to do. So you have this map, and then it's your job as the business owner to make those executive decisions, strategic moves, having the ability to change whatever course you're going down so you can improve it. And that is what makes accounting this wonderful. It truly is a beautiful subject, because it will give you the answers to what you need to be doing in business. You just have to overcome that fear of not looking at your financial statements, not looking at the numbers, because a lot of people are scared because numbers freak out people. One thing, and then the other thing is that they show reality. And a lot of times we don't want to face up to, us losing money, or us not having as a business that should be as profitable as we know it can be. And that can be very frustrating, but we have to embrace our financial statements. We have to go toward that pain, and that's the only way we're gonna overcome this. And not saying that you need to fret or you have to do your bookkeeping, because as a business owner, you need to just have access to those financial statements, being able to read those and make executive decisions. Because if you're spending too much time doing that bookkeeping work, you're actually losing money. You're losing time, and time is very important because you can't get it back. You'll lose and make money over and over again. But if you're losing time, that means you're not focusing on things that can help generate more revenue, more growth for your business. So, you just need to get comfortable with these statements and understand the flow of money in and out of your company, and then taking that information to make better decisions. And again, guys, it can be stressful, but you have to understand that you have to overcome that fear of looking at numbers, and you have to know where you stand. And that balance sheet is very important. Starting off with, it's going to give you where you stand at that point in time. And then it's your decision to make better actions, make a better move, and improve whatever you see on that balance sheet. And how do you improve it? You look at what's going on right now. You compare it to your income statement, because your income statement is basically your actions that you're taking. Okay, so modifying your actions, your approach, and you can improve where you stand, that financial picture, that balance sheet. So hopefully this video has helped. As you can see, I'm very passionate about accounting, about numbers, and helping business owners have more visibility in their company through their financials. And now, financial won't tell you everything, but it will give you, a picture of what's going on through your financial transactions. So if you have any questions, if you would like to learn more, please send me a message. Hopefully this video has helped you out a lot. And if you have any questions, again, just reach out to me. Thanks for watching.